to be recorded. So we have our asset, we have our date of purchase, we have our cost, and we have our depreciation, right? The furniture, we bought it on 1st July 2015, and it cost us 6,500. So they're telling us that the asset register, we are picking it as of 1st July 2016. So this looks like it's an asset that we had bought earlier. We have, that means that if we are to look at our asset register as at 1st July, we should clearly see this furniture, just like you're seeing this asset register here. The incubator, they are showing us that the date of purchase was 1st January 2016, and it cost 10,000. The depreciation rate was 20%. We have irrigation equipment, which we bought on 1st April 2016. It cost us 8,200, and it was depreciated at a rate of 10%. The firm kickstarted an expansion program in the financial years 2016 and 2017 that included the following transactions, among others. On 1st December 2016, the company purchased the following assets. Incubator number 2 at 15,000 to increase the capacity of hatching chicks. The incubator was to be depreciated at 20% per annum. Generator, it was at the generator that was at the was bought at 3.6. It was to be depreciated at 10% per annum. And from the asset register, they're telling us that we removed from the asset register the entire irrigation equipment after it became dysfunctional on 30th June 2017. So I want to believe this is the irrigation equipment that they removed. Then the generator purchased on 1st December 2016 was exchanged for a bigger brand new generator at book value. We now know what book value means. For those of us who have forgotten, it is the net book value stroke the carrying amount. And this is the amount that we get when we get our cost and subtract the accumulated depreciation. The firm topped up 5.2 to acquire the bigger generator on 30th June 2017. I remember giving you an example. For example, when you go, I used the phone at that time. I'm going to use a laptop today. For example, when you go to buy a laptop, you may have another laptop with you at the moment. So you might have actually bought your laptop at 2 million, but when you go to top up because you want another laptop, they tell you that they have valued that laptop at 1.2. So that means that if we were to depreciate that asset, the residual value would actually have if we were to depreciate that laptop, the residual value would have at the end of the day would be the 1.2, which would be our net book value. So yeah, let's say we want another laptop for 2 million and they've told us we only have to add up 800. It means that we have our book value of 1.2 plus another cash of 800, giving us the new value of the laptop. So that same analogy is what we'll apply here with our generator. We exchanged a generator for a better generator. We know that we have our generator here at 3.6, but they're telling us that we exchanged that at the book value. We are going to be looking at that in detail. All assets are depreciated using the straight line method. So all these rates that they've given us, they have told us the company policy is depreciating at straight line method. It's usually very, very important with these questions of non-current assets to look out for the company assets on treatment of these assets. When I talk about that, I mean, what is a depreciation? What is the type of depreciation we're going to use? Are we using straight line? Are we using reducing balance? What is the policy of maybe depreciation in the year of purchase stroke in the year of disposal? Do we prorate or do we charge a full year's depreciation in the event that we bought it in the middle? Companies may decide to give policies on such situations, and you have to follow what the company decides, even if in class you learned something else. So they're telling us that all assets are depreciated using the straight line method. The company charges full year's depreciation in the year of purchase and none in the year of disposal. So what this means is that even if you bought the asset in December 2016, if the year ends on 31st December 2016, you have to charge the full year's depreciation in the year of purchase. So you won't say, no, it has only been around for 1 month. No, you will charge the depreciation for all that as though you have had the asset for 12 months. Depreciation expense is assumed to accrue evenly throughout the year. So that means that if we have a depreciation depreciation expense of 12,000, we are supposed to spread it equally over the 12 months, which is 1,000 per month. Not one month having 2,000, another month having 1,000, another month having 500, like that, no. And then the company financial year ends on 31st December. All payments were made through the bank. So the company financial year ends on 31st December. And they're telling us that this was gotten as at 1st July. These records were gotten as at 1st July 2016. So they're telling us, prepare the following ledgers for the financial years 2016 and 2017. First, they want us to prepare a single non-current asset account, accumulated depreciation account, and a dispose of non-current asset account. These numbers will usually look like this. A number about non-current assets will usually ask you, surely it will ask you for a non-current assets account. Of course, the word single, it may confuse you, but it shouldn't ideally confuse you, because they just want you to, what this you interpret it as is that they want you to get all the non-current assets and put them in one particular T account. Accumulated depreciation account, like we're going to look at for the financial years of 2016 and 2017. Dispose of non-current asset account, we're also going to look at that. So let me give you just a small second, settle yourselves in, and then we can look at the solution. Okay. Let me know once you can see my screen. And please, I hope you have the question with you. I shared it the week before the last. So part one, we're going to prepare our single non-current asset account. So I've come to, of course, my page, and I'm going to draw my my current assets account. Put my headings and titles as usual. Fill in my particulars. Of course, I have to show the dates, the particulars, the shillings, the denomination in which the money is in, and the level of precision, which is thousands. Please don't forget to put the level of precision, because when you do not, then you are talking about totally different money. So we start our question. We start answering our question. They're telling us in the asset register as at 1st July 2015. So one thing to note is that they've told us that the financial year ends on 31st December. So I'm just going to put here, that means that our year moves from our year moves from 1st January to 31st December. I'm putting this here so that we are very keen on dates, and we don't end up putting money. We don't end up putting the wrong figures where they do not belong. So this is just going to help all of us remember. In case you see that I'm putting money where it doesn't belong, you let me know. In case you think money should be somewhere else, you let me know. And if you're right, we'll correct. If you're wrong, I will let you know. So keeping this in mind, 1st January to 31st December, we come back to our question. They've told us that in the asset register, this is what was there. Remember, we are doing a single and non-current asset account for 2016 and 2017. So that means that we start with the year 2016, because accounts are progressive. You can't create accounts for 2017 when you've not made accounts for 2016. Why? Because there are some balances from 2016 that will make up 2017 accounts. And even life, you don't move life backwards. We are right now in 2025. There's no way you can prepare accounts for 2020. So we are right now in 2024. There is no way you can prepare accounts for 2025. So systematic movement of the account. So we're going to come and get our first asset. We look at it. They're telling us that furniture, it was purchased in July 2015. So if we are looking at the year 2016, means that this furniture, we will probably enter the year with it. So for our first non-current asset account, our opening balance will have to be the asset that we already had existing, which is in the non-current asset account. One of the things that you have to remember is that we record items in the non-current asset account at cost. The values that enter this non-current asset account is basically the cost. It's basically the account version of an asset register. An asset register is a financial record that keeps records of assets. So if you say you have, let's say it's on a personal level, you say you're a rich person, we are going to ask you what are your assets. And you tell us you have land, you have a car, you have a big house, and we'll ask you the value of those things. You'll not tell us the value after depreciation. No, you will tell us probably the value of maybe how much your car cost you, how much the land cost you. And so that's the same idea with a non-current asset account. We're going to majorly record these items that we're going to record in the non-current asset account will be at cost. So the balance brought forward will be for the furniture, which is a 6,500. And then they're telling us that another item we have is an incubator, which was bought on 1st January 2016. So in the year 2016, we bought our incubator. We're going to come and debit our asset account with the incubator value. Moving on, we have our irrigation equipment. We bought it on 1st April 2016 at 8,200. And so we're also going to come and debit our asset with that match. So when we debit our asset, I hope you remember that we have a corresponding entry. They told us that these transactions are being made in the bank, but have not opened up a bank account because they didn't ask me for it. Though in case you asked for also a bank account, then you will do the regular double entry, which will be for the furniture. Of course, it's a balance, so you can't put it in the bank. Okay, it has already been spent out. So if it was a bank account, we will debit our non-current asset account, like you're seeing us, and then if we were to get our bank account, would have the same T account and would credit the bank with these items that we have purchased because our bank balance is reducing. Okay, so we have picked that. The firm kickstarted an expansion program in the financial years 2016 and 2017 that included the following transactions, among others. On December 2016, the company purchased the following assets. So we are still in 2016 and we are seeing things are still happening. We have our incubator number 2, which was purchased at 15 million. We are going to come and debit our asset account with the cost of the incubator number 2. Then they told us we have a generator at, we purchased a generator at 3.6. We're also going to come and debit our asset account with generator 3.6. And of course, like I told you, if you had a bank account, we'd credit the bank account with the 3.6. So looking at the question, let me know if there is anything else that we bought in 2016. But as far as my eyes can see, we removed from the asset register, generator December 2016 was exchanged in 2017. Assets depreciated, this is a policy. So I think that is it that we bought in 2016. Did we have any disposals in 2016? Because if in case we are removing any items, in case we are giving away any items and we're no longer owning them, that will also affect our asset register. Like I said, when someone asks you how many assets do you own, you're going to say you own a piece of land, you own a car, you own maybe cows and whatnot. And let's say you sell off maybe the land. The next time someone asks you, you're only going to say you own a car and you own cows and you own a house. You won't say that you have land. Why? Because you know that you sold out the land. And so that's the same thing that is going to happen. The non-current asset account. If we had removed an incubator, we will show that we removed that incubator, probably sold it out. So we balance our 2016. When I add that up, it should give me 43,300. So balancing that as at December 31st, 2016, I get my balancing balance, which is 3,000. So my opening balance for the new year will be for 1st Jan, because we went to sleep on 31st December, woke up on 1st Jan, and this is the same balance that we had. So our balance brought forward will be 43,000, 43.3 thousand. So now we start seeing what happened in 2017. We have already recorded the 15 million. Here I'm seeing in the asset register, there is nothing like 2017. This is 2016, the generator 3.6, that is 2016. Removed from the asset register the entire irrigation system after it became dysfunctional on June 30th, 2017. So they're telling us that this irrigation equipment was removed because it became dysfunctional. So we are going to come to our asset register and we are going to show that on 30th June 2017, we disposed of our irrigation equipment. We disposed it off at how much? We disposed it off at the cost. We are writing it out of our asset register. So we can only write it out at cost, in that when you subtract the 8.2, okay, minus this 8.2, you have 0. So you have written it out of your asset register. You debited it by bringing it in, and you've credited it in, credited it by taking it, you've taken it out by crediting it. Okay, please let me know if you have any questions. If you have any contribution, feel free to unmute and contribute. So they're telling us, we are here, they're telling us the generator purchased on 1st December 2016 was exchanged for a bigger brand new generator at book value. First and foremost, before you even exchange, let's first know what the book value is of this generator. They're telling us that the generator that we bought on 1st, this is the one that we bought at 3.6. It was exchanged at book value. So we need to find what the book value is. I'm going to come on the side and make my note, my workings for my generator. So we know that our net book value is gotten by getting the cost minus accumulated depreciation. The cost of the generator, we are well aware, it is the 3.6, okay? The policy tells us that the company charges full year depreciation in the year of purchase and none in the year of disposal. We bought this generator in 2016 and we disposed it in, we are making the disposal in 2017. So we are going to record the disposal in 2017, in as much as we bought the generator in 2016. Okay, so we bought our generator 2016 at 3.6, and the company tells us that we depreciate in the year of, we charge full year depreciation in the year of purchase. So let's start depreciating our generator. We bought it in 2016, okay? It cost us 3.6. The depreciation rate for this is 10%. I am sorry, I have a problem. Sometimes I like to do quick math, but please let me know in case we make an error. So if the cost is 3.6 million, let me just make sure my zeros are right. Okay, yeah, my zeros are right. 3.6 million, what's 10% of 3.6 million? 10% of 3.6 million should be about 360. So the depreciation for the first year, for the year 2016, because it's the, okay, let me just show you here, 2016. Okay, in 2016, we bought the generator at 3.6 million. Okay, so they tell us that we charge full year's depreciation in the year of purchase. So I'm going to charge the full year's depreciation. I'm going to get my 10%. 10% is equivalent to 0.1 times 10% times the 3.6 million, which should give me 0.36, which is the same as the 360. Okay, so now I have gotten the charge. So at the end of the year, at the end of 2016, that means that the net book value of the generator was 3.6 minus the 360,000, giving us a net book value of 3.2. So when we come to the year 2017, okay, we come and see what happened to the generator in 2017. They're telling us that the generator was exchanged for a bigger brand new generator. So that means that it was disposed of. We took it out of our books. Why? Because we're getting something else. So we gave those people that generator. So we can't depreciate because we're taking it to be a disposal. We gave up that generator for something else. So in 2017, we cannot have any depreciation. So that means that the book value that we have even as of 2017, because the policy tells us that there is no depreciation in the year of disposal, is 3.2 million, 3.24 million. So I'm going to now, let's go back to our notes. I'm going to come and get my accumulated depreciation, which is a 360. And when I get the net book value for that, it's 3,240,000. So they told us, back to our question here, they told us it was exchanged for a brand new generator at book value. And then they told us that the firm topped up 5.2. So after valuing the old generator, and they said, we will, inclusive of the book value, you also add us 5.2. So after valuing the generator and saying, it's now worth 3.2 million, you're going to add us another 5.2 cash. So they went ahead and added the 5.2 on the already existing 3.2 million. So we are going to get our book value. For us to get the new value of the generator, we're going to get our book value of the old generator and add it to, and add the cash that we pay, which is a 5.2. So when we add the 5.2 plus the 3.28, 24, we get our generator value being 8440. Do we have any question on that? Because you get these exchange scenarios a lot. You need to be very careful with your English, and you also need to be very careful with how you interpret it. Do we have any questions for now? Okay, silence means that we are progressing very well. I'm going to put my date. Okay, going back to the question, let's see what else happened in 2017. So we have disposed of the old generator, and we have also topped up the 5.2 to get the new value. Then they're telling us all assets are depreciated in the straight line method. I want to believe that is all that happened. Okay, that is all that happened. We have acquired our new generator, and we have also disposed of our old generator at cost. So we are writing out this generator that we bought. Okay, we are getting it out of the register, because it's not going to, even if someone asks for our list of assets, it's not going to appear there anymore. So this 3.6 and this 3.6 will have to cancel themselves out. So we have written out our generator. We have our new generator, which is worth 8.4 million. So let's balance that off. This is the bigger side, I believe. When I add that up, how much do we get? When we balance this off, how much is the total? What's the total value of assets we now have as at the end of 2017? We have bought a new generator, we have given out an old generator, and we've also disposed of irrigation equipment. Please, I'm waiting for your answer. Calculate and we can move on. What is the total? What is the balancing figure? 5174. Yes, thank you, Patience. So when we add that up, it's going to be 5174. Thank you for that. So I'm going to come and balance my figures. Okay, so what is the balancing figure here? When we get our 51 against, thank you, Faith. When we get our 51 against this 8.2 plus 3.6, what is our balancing figure? What is going to be our net balance carried forward? as at the end of 2017. What is our balancing figure? 39.940. Thank you so much. That will be our balancing figure. So it means that in the new year, we are going to enter with our asset value being worth 39.9 million. And so they asked us to calculate for 2016 and 2017. These are the happenings that happened. These are the items that, these are the events that happened in 2016 and 2017. So we have so far earned our 5 marks. Now let's go and look for our 7 marks. They have told us in part 2, accumulated depreciation account. So of course, as usual, I'm going to come and create my T account and fill in my details. And we are going to get started. Now, like I was telling you last time, with the accumulated depreciation account, with this kind of question, the moment you have a non-current asset account, it's kind of like a pivoting point. It helps you find direction for the next questions. So when you have a wrong item in your non-current asset account, it's very, very likely that it will have a ripple effect throughout the whole number. But of course, in accounting, they mark entries, so that shouldn't scare you. Though it's usually best to try to be as accurate as possible with your non-current asset account, so that when even you're doing the disposals and the accumulated depreciation, you have accurate figures. But if you're not sure of yourself, if you're not sure of your non-current asset account, you're not going to do what I'm going to do. Me, I was going to come to my non-current asset account and depreciate the items that are in here. But if you're not sure, you will come back to your question and you come all the way from the start. We have assets in the asset register. We have our furniture, which was bought on 1st July 2015. The question asked us to record transactions of 2016 and 2017. That means that with 2016, we had our opening balance, which was a furniture amount. So when we open up our accumulated depreciation account, okay, it means that we had a balance that we opened with. The fact that we had furniture that was bought in 2015 means that that furniture must have been depreciated in the previous years, or even if it was bought in like 2010, and we are now even just looking at 2016, we'll depreciate it all the way from the day it was bought till now. So let's assume it was bought in 2010. Our furniture was bought in 2010, and we are still looking. The question has asked us to look at transactions of 2016, because that may happen. You may find a question that will ask you for very, very many years, and it's okay. It's okay. You can still attempt it. So if our furniture was bought in 2010, we would get, of course, our 6,500 and get 5% of that. So 5% of 6,500, I'll make that 0.05 times 6,500. So our yearly depreciation charge, because it's a straight line, so it's not going to change for every year. It's going to be 325. So for 2010 year 1, 2011, 2013, 2014, 2015, 2016, 2017. Okay, so I'm going to remove this. And even if the question had asked us, and maybe even if the question had asked us, even when the furniture had been bought in 2016, would still just get our accumulated depreciation. Our opening depreciation would then have to be, because if this year 1, let me just make it 2010. 2010, 11. Okay, it's not following. 2011, 2010, 11, 12, 13, 14. I need an extra, 2017 here. So we are telling you that we bought our asset in 2010. So even if it had been bought back then, and we are still attempting the same question, it's telling us to look at dealings of 2016 and 2017. Okay. We will calculate our accumulated depreciation from the year of cost, because they told us full year's depreciation in the year of purchase. So it would of course be our 325 plus this 325 plus this 325 plus 325 for 2014 and 325 for 2015. So we would have had a total cumulative depreciation of 1950. So that would have been our opening balance. Okay, because cumulative depreciation adds up. It adds up as time also goes on. As the years go on, you keep on adding the depreciation and it keeps on increasing. So you add annual depreciation of this year plus annual depreciation of the previous year. The balance you get, you keep on adding for the following years. So it means that if we were to open our year 2016 and it had been purchased in 2010, our opening balance would be this 950. And so for the accumulated depreciation as of the end of 2016, it would have to be our 950. It would have to be our 1950, sorry, plus our 325, and that would be the depreciation charge for the year 2016. And then, of course, would still go on and do the same for the year 2017. I got the 1950 by adding the 325 plus 325, sorry, plus 325 plus 325 plus this 325 plus the 325 for 2013 plus the 325 for 2014 plus the 325 for 2015, which gave me the 19,500. So I added up those different years to get the accumulated depreciation. So getting back to the question, we know that they didn't give us all the years from starting from 2010. They only told us that it was purchased in 2015. So we will depreciate for 2015. Let's just remove this, doesn't confuse you. We'll come and calculate our depreciation for 2015, which will be the 325, okay? Because it was bought in 2015, we are going to come and calculate our depreciation being 5%, which is 0.05 times 6,500. So our depreciation for the year 2015 will be that. So that will be the 3,000 to 300 sorry, 325 for our year 2015. And so that means that when we open our year, okay, when we open our year 2016, we shall carry over this 3,000, this 325. So our opening balance, just like you saw, we opened up with the asset value here. We're going to come and open our accumulated depreciation account with the depreciation of the asset that we had at that point. So then we'll go back to our question. We told us that we bought an incubator on January 2016 of 10,000. It was depreciated at 20%. If it's a straight line, I'm just going to get 20% of 10,000. How much is that? How much is 20% of 10,000? 20% of 10,000, it should be 2,000. So I'll add my 2,000 there. I'll depreciate now my incubator. Thank you, Alan. And then moving on, they told us we have irrigation equipment that we also bought out 8,200 at 10%. When I get 10% of 8.2 million, I get 820. Thank you. So I will add my 820 there. So we move on. What else did we purchase in 2015? Sorry, in 2016. December, they purchased an incubator number 2, 15 at 15 million. The fact they have not given us, they've given us it's at 20%. So we're going to get our 20% of 15 million. How much is that? How much is 20% of 15 million? $3 million. Yes, thank you. So we're going to get our 3 million and put it there. Going on, we have been told that they also bought a generator at 3.6 and it's depreciated at 10%. So what shall we do also for that? We shall get our generator and depreciate it at 10%, which will give us 360 like you had seen. And so Now, remember our furniture, we depreciated it and we had an opening balance, okay? We had an opening balance of our furniture, our accumulated depreciation of the furniture at 5% of 6.5, which gave us 3.2. That was depreciation that was carried forward from the year 2015. So now we again need to depreciate the furniture in this next year of 2016. So we'll still get that 325 and depreciate the furniture in this current year. Okay, in the current year of 2016. So I'm just going to refer back to the non-current asset. You're seeing that in my non-current asset account in the year 2016, I had only transactions that were happening on the debit side. Okay. So now you look at it like this. Accumulated depreciation reduces the value, reduces at least the book value of non-current assets. When an asset is increasing, we debit it. And anything that will reduce the value of these assets will be put on the credit side. So to help you remember, that's why I said non-current asset is kind of the pivot. It's a pivotal point for the rest of the question. To help you remember on what side to start with the accumulated depreciation, okay, you will look at your non-current asset and you will know that your assets, when all the time you are increasing them on the debit side. That means that for you to reduce them using depreciation, you have to reduce them on the credit side. And so that's just the trick to help you remember what side you open accumulated depreciation on. This I remember when I was doing this paper, it took me a while to figure it out until I practiced and got it. And that was how I saw it would be easy to remember it. So I'm going to balance off my account. Please let someone add for us what this is going to be. Our balance brought forward and the depreciations for the year of 2016, how much that will be. Please, anyone? Okay, 6,830,000. Thank you for that. Yes. So we balance off our year 2016. So that means that our opening balance for 2017 will be the 6,830,000. And so we're going to come and open our year 2017. So we go back to our question because I'm assuming that we are not sure of our non-current asset account. But if you're very, very sure of your non-current asset account, then it can guide you on what to depreciate next. Now, before we even go back to the question, okay, the fact that you have already depreciated these items and they are still being depreciated, okay, except for those that are going to be disposed, you can always just copy and paste the depreciation and put it in the next year. That is because it's straight line. But let's first look at the disposals first, and then we will see where we will depreciate all the rest. So the question is telling us, with these purchases, we will have to depreciate furniture again for the year 2017, incubator for the year 2017, irrigation equipment for the year 2017. So I can still go ahead and get all those depreciations. But let's first deal with the disposals because they will adjust our depreciation also a bit. Okay. So this is also a purchase. We shall look at the purchases. Last, the generator 3.6. So we will start with our depreciation. Remove from the asset register the entire irrigation scheme after it became dysfunctional on 30th June. The entire irrigation scheme cost us 8.2 and we removed it. So like you saw in our non-current asset account, we disposed of the irrigation scheme. So just like we wrote out, just like we wrote the irrigation equipment, not irrigation scheme, just like we wrote out the irrigation equipment, we also have to remove that depreciation from this 6.8. Because remember, accumulated depreciation is the total cost of depreciation for all the assets that we have over the years. So if we keep on adding the 820, because it's the depreciation for the irrigation, it's this 820. If we keep on adding that 820, it is going to increase our depreciation expense. Yes, this asset was already written out of our asset register. So what we are going to do, we're going to also remove that 820 from this 6.8 million. So for us to remove that, because this is our opening balance, we are going to come and debit our depreciation account with the 820. So this 820 will reduce on the total accumulated, we will remove it from the accumulated balance for the year 2017 because it doesn't exist. Also, they told us that we do not depreciate in the year of disposal. So we are not going to add any more depreciation. You may ask me that why aren't we first going to add another 820 before we remove it? The company policy told us that we do not depreciate in the year of disposal. So we're just going to get the depreciation that we already have and write it out. If it was allowed that we depreciate in the year of disposal, we'll depreciate and then we write it out. Okay. Moving on. What if they don't mention the year of disposal? I'm not very. Could you kindly be clear with the question?
Okay, like what if they don't mention that in the year of disposal, they don't depreciate? Do
Then
we assume that we are going to depreciate that asset in that year of disposal?
Yes.
Okay, thank you.
Okay. Okay, so moving on, let's get our other disposal. We have a disposal here. Generator purchased on December 1st, 2016 was exchanged for a bigger brand new generator. The firm topped up 5.2 to acquire a bigger generator on 30th June. So that means that the disposal was made. We're going to take it that the disposal was made on the same day the new acquisition was also made. So we are also going to write out that old generator because like you see with our non-current asset, we disposed of this 3.6. We wrote out that generator out of our assets. We also have to write out that depreciation out of our assets. So we're going to come and show that on 30th June 2017, we disposed of our old generator at, we wrote out our depreciation of the old generator, which is at 360. Looking at the now, like I told you, this is going to be your guide to help you very much, as long as you have the correct entries in your non-current asset account. I don't see any other disposals apart from the irrigation equipment and the generator. So I want to believe I've written out the right. I've written out the correct entries that are supposed to be written out. So that means everything else that has not been disposed is going to be depreciated as usual. So just to avoid repetition, I'm going to highlight what we have disposed of from my first year, and then I'm going to carry forward everything else. So incubator number 1, we are going to depreciate it in 2017 again at 2,000. The depreciation charge, we are going to show that it's 2,000. So we have entered that. We have incubator number 2. We depreciate it each year at 3,000. We are going to show that we depreciate it at 3,000. We have our furniture, which is at 325. We are going to show that we depreciate it at 325 each year. And now, remember in the new year, okay, in 2017, they told us that we acquired. Coming back to the question, they told us that on 30th June 2017, there was a bigger generator that we acquired. That bigger generator cost 5.2 cash and 3.2 as value of the old generator. When we add that up, we get, did you guys give me the answer for that? Let me check here. If I ask someone to help us calculate when you've already given us. You did not. What is the value of the new generator? What do you think is going to be the value of the new generator? 84408.4 million. Yes, it will be 8.4 million. So we are going to get our value of the new generator, which is 8.4 million. How much, what was the depreciation? Now you see here, they have not given us the percentage that the new generator is going to be disposed at. So what we will do, we will take the rate of the generator, the rate that we have that is in the class of generators. Another thing that I forgot to tell you, or I must have mentioned, is that usually with an asset register, we have classes. We have classes of assets. So you'll find things like plant and equipment will have a rate that is similar. You find things like building having a different rate but similar rate. So you find that if you have maybe a bungalow, you have a storied building, you have maybe the building with more stories than the other. The fact that they're all in the same class, they will usually have the same depreciation rate. So that's the same ideology I'm using here. I'm not just forging or manifesting the generator depreciation rate. The fact that we already had a generator earlier on, it is easier for me to know that the class of the generators is depreciated at 10%. That may not be textbook knowledge, but it's knowledge that you're going to have to know from here, and you also apply even when you're practicing your accounting. So I'm going to depreciate my 8.4 by 10%. When I get 10% of 8.4 million, I should be able to get 844. Thank you. So do we have anything else? Let me refer to my asset account. I think I've depreciated every item. Is there any item I've not depreciated for 2017? Please look through. Is there any item you feel I've left out? Okay, silence means that we are okay. So let's balance it up. Can someone get us, this looks like the greater side. So someone get us the total of 6.8, 2 million, 3 million, 325, and 844. What's the total of that? Let's see, 12.999. Thank you, Faith. 12.9, thank you, Peace. Yes, it's going to be 12.9. Thank you, Alan. So we are going to balance that up. What would be the balancing figure then? What would be the balancing figure as at 31st December 2017? $11,819,000. Perfect. Thank you. Okay, so that means that for our accumulated balance brought forward for 2018, it will be 11,819,000. Okay, so that will be it for the 2 years for accumulated depreciation. And that is how we are going to earn our, let me see how many marks, 7 marks. Easy 7 marks that we can earn. Okay, the next part of the question is asking us to get the disposal of non-current asset account. So with the disposal, it's quite straightforward. The fact that, like I told you, the fact that just make sure that you have a correct non-current asset, and this part is easy. Correct non-current asset, always remember the principle that rule it, assets increase by debiting them. So every time you're buying an asset, you debit the asset, you credit the bank, or you credit cash. Assets increase by debiting them. Second thing, you record items in a non-current asset account at cost. And the account records only purchases and disposals. And that's it. So the rest will just be English, and you will practice. And I know by the time you reach, the English will be familiar. So you have asked us for our disposal account. I'm going to, of course, get my heading and fill in my template. Okay. So first of all, just to earn a few easy marks, I'm just going to do double entry. These disposals that we made in our non-current asset, we debited, we credited our non-current asset account. That means that we're going to have to debit our disposal account to finalize the double entry bit of this. So in my disposal account, I'm going to come and first get these items. I'm just going to do a corresponding entry. That's just me try to get some free marks. I'll get my 8.2 and my 3.6 and take them to my disposal account and debit them there. So that will be it. Okay, that will be it. So the next thing that we'll do with the disposal, just like you saw us writing off, just like you saw us writing out after we have looked at the non-current asset, we have done the double entry for that. We'll also come to our accumulated depreciation and see anywhere where the word disposal is, and also do the corresponding entry. When I check my non-current asset account, please, you may ask me the years I'm seeing disposals happening in 2017, so I'm not mixing up periods. But in case the periods were different, then I would go systematically year by year and dispose of year by year. So I'll come also to the accumulated depreciation account and look for any double entry. I have my disposal here, and also here I have my accumulated depreciation account. I also had written out this depreciation for these items that we dispose. So I'm also going to come and still make the double entry in my disposal account. Okay, so I have done an easy what? An easy double entry. At least there's a few marks I should easily have. Now, the only thing that is going to be new here that we've not yet already looked at is the fact that we disposed of this generator, this 3.6. Okay, this 3.6, this generator, we actually disposed it of, and it shouldn't be in our account like you saw. We disposed it off here in the 3.6, and also we wrote out its depreciation in the 3.4. We're going to get, for us to be able to get the total value, the total disposal value, we are going to totally dispose it off. We're going to totally write it out of our assets. And so we're going to credit our disposal account with the book value of the old generator, which is going to be the 3.24. And then when we balance that off, it will be 11.2. So someone get me the balancing figure when I add the 8.2, 360, and the 3.2 against the 8.2 million. This is what? This is that. Okay, so what is the balancing figure? What do we have as our balancing figure? $7,380. Yes, so our balancing figure is going to be 7,380. Now, I need to explain something to you in a very, you will forgive me for those of you who are uncomfortable with my way of teaching, but I like to believe that when you have these concepts in a more realistic setting, it's easier for you to manipulate your knowledge to answer any kind of question. But if it's uncomfortable for you, then you feel free to reach out later on, and I can always change. Why are we including the book value under disposal? Okay. The disposal account is an account that's going to help us write out assets. Okay. we came and for the irrigation equipment, we disposed it out totally. We didn't have anything like exchanging money for it. We didn't have anything like maybe buying another irrigation equipment. We just wrote it out totally, and that was it. And so we totally got the irrigation equipment out of our system. For the generator, we bought it at 3.6, okay? But we still retained a bit of that 3.6 in our business. Like the fact that we exchanged it for something else, it means that we still have the book value, at least that we have, sorry, I'm trying to get the right words. The fact that we exchange it for something else, just like you see, when we're getting our new generator, it's inclusive of the 3.2 plus the 5.2. So if we write out our generator at 3.6, it means that we have totally removed it from our assets. But the fact that we got a bit of value from this generator, you take it like we sold it. We take it like we got money from it, because if we actually got money from it, that would be the same entry that we are making. So the fact that we still have some value for the generator, we still got some money, we still got, ideally, in air quotes, some money from the generator, we're going to come and credit it in the disposal account, so that it reduces the value of the total, so that it shows the net value of the generator that we actually took out of our business, because we didn't actually throw out the whole generator at 3.6. We got our generator at cost, and we exchanged it when it had only reached 3.2. So you take it like we got our generator and we sold it, because if the question had told us that we sold our generator and they gave us cash, this would be the same story. Our disposal would have been reduced by the cash that they gave us. Does that make sense? Faith, does it make sense? All right. So our balancing figure being 7.38. So our balancing figure, whatever side it will be taken to our income statement. The income statement, like the way you hear the word income statement, it increases on the credit side. Income increases by crediting it. So every time you're increasing, you're making the income statement positive. Every time you're increasing the income statement, you're crediting it. So now, for you to know what side, for you to know whether you've made a loss or not, you're going to look at the double entry that you have to make. So we have our balancing figure being on the credit side. We have our 7.3 being on the credit side. What that means that when we are this, whatever figure you're going to always balance off on the disposal account is going to always be taken to your income statement. So you have to make a corresponding debit. You have to make a corresponding entry. Here we have our balancing figure on the credit side. So that means that we have to debit our income statement, okay, with the 3.7 and credit our disposal with that 3.7. The first part of the entry has been made, which is there. And so the next part will be writing it out of here and putting it in our income statement. So the fact that it's going to debit the income statement means that it's going to reduce the income statement. That means that it's an expense to the income statement. So what that means is that it's a loss. We have sold out these things and we have sold them out at a loss. Now, minus looking at it from an accounts perspective, let's just go layman and I show you how you can even easily determine. You had irrigation equipment worth 8.2 million. You had a generator worth 3.6 million. Okay. You had depreciated the irrigation equipment. So you just look at it. I'm just doing for you rudimentary, math. But I just want you to understand the concept. Look at it like this. You bought your irrigation equipment at 8.2. You threw it away totally. You didn't even get any other money for it after depreciating it for 1 year. So you basically threw away 378. On the other hand, you had your generator you also bought. You had your generator you also bought at 3.6. You decided to give it out, or you decided to do away with it when you had depreciated it by only 360. But this time around, instead of giving it out just for free, they could have given you cash. Let's take it like people gave you cash, or they told you top up some more money. So it's equivalent of them paying you. So people instead paid you the 3.24. So you see, you didn't make any loss on the generator. It had served its some little value. It had given you some little value by the 360, and even the remaining value that it had, the suppliers allowed you to just top up less money so that you can afford a generator of 8.2. You could have just given it out totally, and that means that you'd have spent 8.4, full 8.4. But as a business, you saved 3.2 by having an old generator that you gave out. What does this mean? When you add up these items, when you add up the things that you have disposed of, you know that you got some money for the generator after removing the depreciation, but you know that you threw out this after removing the depreciation. So that means that you made a loss. You naturally see that you made a loss. You had an irrigation equipment of 8.2 and you had only depreciated it by 820. So you threw away 307.3 million. You threw it away just because it was dysfunction. So even you, when you use your logic and just look at it from a very layman's point, you can see that you made a loss. I hope that helps just a bit. So we are going to show that we made our loss on disposal, and we will take this loss on disposal. It will be under expenses in our income statement, like we'll be looking at when we look at financial statement, preparing of financial statements. Hopefully that should be Monday next week. Hopefully. Okay, do we have any question?
Is it okay you send us the question and at least a copy of this solution?
Yes, please. I'll send them right after the lecture.
For me, I have a question.
Yes, please.
Yes. I understood the two accounts. First one was the asset account, and it was recording purchase and disposals at cost. Also, the depreciation account was recording the depreciation purchases and the depreciation disposals. Those are, yes. But the last account, I just understood that it records the disposal. That is on the debit side, true? And the disposal value, disposal depreciation on the credit. Plus maybe the loss and the profit. Now, my question goes, if I have an asset and this asset is impaired, let me assume that I have an asset, I have got it at 50,000. Then that asset impairs, and now I can sell it at 10,000 without depreciating. And now, for me to sell it, I have to repair it using 1,000. How do I account for that?
Okay.
At cost.
Okay. So we have taken it that the day you bought it, you did the right entries, you debited the asset, you credited bank, you said you've not depreciated it, so we are not going to depreciate it at all. So we are disposing of this asset and we have an impairment, so it's basically spoiled. We are going to get our assets, our 50,000. We're going to get our asset, which is 50,000. Okay. we are disposing it off. They're giving us only 10,000. So we are going to increase our disposal value by 10,000. So this will be our cash on disposal. Okay. But we are incurring costs to help us with we are incurring costs to help us to dispose of this asset. That extra 1,000 is going to be a cost. It's going to be a cost. We call it a cost of disposal. So we're going to add, it's going to be a cost that's going to reduce any profit that you would have made on your assets. So yes, you had your cost of 50,000, but you had your assets, you're disposing it of, or you had your asset, you're writing it out of your books by 50, and now you have a cost of disposal of 1,000. So now, in addition to the cost that you already paid for the asset, you're now incurring another cost to get the asset to even be sold. So it's as if you're trying to increase the value of the asset. So you're going to add that 50 and the 1,000, which is going to give you 51,000. Okay, and so this is the total cost now of the asset. This is the total cost of the asset. So when you dispose it off, they give you only 10,000. That means that the net loss that you will make, because you have your asset valued at 50 plus now the 1,000 that you have incurred cost of disposal minus the 10,000, that should be about 41,000. So you have your loss on disposal. Loss on disposal at 41,000. And so you balance off your account. And that will be it. If it was just impairment and you decided to not dispose it off, would have an impairment loss, and that would be the end of the business. That would be the end of the asset. So does that help? Yes, please.
I got it.
All right. Well, anyone else have any question? Okay, let's just have a 6 minutes break and then we can look at accruals and prepayments. Okay. Can you hear me? Can you hear me and can you see my screen? Okay. Did you go through the accounting concepts at the beginning? Do we have knowledge of that? Do we have knowledge of any accounting concepts? People, do we know accounting concepts, or have we ever heard of the word accounting concepts? Fred, could you help us tell patients what you know about accounting concepts? Who else has an idea of accounting concepts or does not have an idea? Accounting concepts of, okay, that's something. Well, before you go for the examinations, yeah, Faith and Fred and Mwajibu, you're going to tell us about accounting concepts. Mwajibu, you can go first, and Faith next, and then Fred. Tell us anything you know about accounting concepts. Business entity concept. Okay. What about the business entity concept? You see, we have ideas of what these concepts are. Yes, Fred, what example are you going to give us? Going concern concept. Okay. What other concepts do we know? What other concepts do we know? Business entity, period and disclosure, accrual concept. Okay. Okay. So we do know a bit about accounting concepts. We'll go back and read through them. It's the foundation. It's the foundation of all those concepts. Thank you, Faith. We also have matching concepts. Those concepts are the foundation of all the calculations that we make. They are like, for lawyers, they have, I think they have, no, Christians have Bibles and Muslims have Quran, and I don't know what the traditionalists have, but these are the baselines these are the baselines that guide how you report as an accountant. So it's very, very, very important. These are things you'll be examined about, but even outside the examination, it's very important that you know these concepts, you know what they are about. You have to familiarize yourselves with these concepts as much as you can. The going concern concept, do we know more about the going concern concept? Basically, an idea of that is that businesses will have to make reports showing that they will exist even in the future. So the reports have to give an idea that the business is not closing. So if you're reporting for 20, like you've been seeing me balance, I close my account, I close a T account, and I open the next year. That's a going concern concept. I'm showing that the business is still going on. If it wasn't, I would close and then I would give out the money to someone. Like we will see with partnerships, we will close businesses and we'll see how a business looks like when it's closing. We have accruals. Faith, you told us about accruals. We have materiality. So we're going to take time off, all of us, all of you. We'll take time off, go and read these concepts, internalize them, see how they even apply in your calculations. It will be best for you to remember them when you see how they apply in your calculations. When we start with the financial reporting, it will be very, very important. I cannot stress this enough. It will be very important for you to know those concepts. Please don't just cram them for the sake of tickling objectives and writing sentences. Learn them and see how they apply in your daily accounting. Because like I told you, very many scenarios will always happen. Examinations will bring all types of scenarios. Practice will bring all types of scenarios. But once you know your concepts, you will always find a way to adjust those numbers and give the right answers. The examiner uses these same concepts to come up with answers to questions. Practice, you'll use these same concepts to come up with clear reports. In your exams as well, you come up with you'll use these concepts to come up with the right answers and the right adjustments. So for the accruals and prepayments, at least you've seen one word there, accruals. So it should be something. We'll be looking at what accrued expenses are, what prepaid expenses are, and majorly for this for accruals and prepayments, it's very relevant for us to understand what the matching concept is, and also understand, of course, our double entry and the effect of these accruals and prepayments on profits and net assets. Can someone tell us what the matching concept is? Do we know what matching concept? Someone mentioned it. Let me see who mentioned it and they tell us what the matching concept. Faith, what is the matching concept about? What is the matching concept about?
Matching concept is where revenues should match.
Okay. Yeah, we lost you on the last part, but yes, you're right. Revenues should match with expenses in the same accounting period. And it's the baseline of accruals and prepayments. This is something lecturers like to examine about accruals and prepayments. For some reason, it's a concept that students find very hard to grasp. But once you know your matching, always come through. So again, look at accrued expenses first. The expenses, we're saying that there are expenses which relate to an accounting period but have not been paid for. So for example, let's have our business as our finance class. What are we going to? Maybe we have a boutique. No, let me not use a boutique. We have an office. We as an accounting class, we have decided that we're going to make an office for ourselves. We have insurance, we pay for our employees, we have electricity, we have water bills, we have rent. And so let's take it that we are in the year 2024. Maybe we paid rent for the year 2024. Okay. Maybe we paid rent from we paid rent for the first 6 months and decided that we will pay the next rent in Jan 2025. So what does that mean? It doesn't mean that we will not report just because we've not paid rent. But you find that the year is ending, maybe our 2024 December is ending, our year is closing, but we haven't paid this rent. We haven't paid the rent. So what are we going to do? What we will do, where you are seeing payables, when it comes to trading, these we'll call them accrued expenses. We'll accrue those expenses. We will show that, yes, this expense was relating to this particular period, but it wasn't paid in that particular period. So the rent that they're going to be demanding us for the last 6 months that we didn't pay, if we dare report before we pay, it will have to be an accrual, because either way we have consumed the rent. We're not going to run out of the house. We have already stayed in the house and they're already demanding us the rent. And so we will show it in our liabilities as an accrued expense. So let me just take you back. For sales and purchases, I'm just going to show you a correlation with this. Remember when we were having our sales, we'll debit our cash, okay? And we credit our sales. And when people don't pay, we debit our receivables and we credit our sales. For purchases, we are debiting our purchases, okay? And we are crediting our payables. This is trading. When I talk about trading, I mean sell and buying of goods. Everything else, apart from my actual assets, everything else that doesn't fall in trading, you don't call it a payable. Because the moment I see the word payable, I know it's for trading. What payable is to trading items is what accruals is to other expenses. Do you see the logic there? What receivables is, okay? What receivables is to trading items, prepayment is to any other expenses. So they are all liabilities, but they are just called different words. They are called different names at the end of the day. That is it. Nothing fancy about it. If an accrual is a liability, they are demanding you money. It's an obligation you have to give. The business has to sort, and so you call it a liability, and you show it as a liability. If it's a prepayment, it means that you have paid in advance, and so you're the ones demanding people. You may find that maybe you have paid rent for like 3 years and you've not yet even accumulated the 3 years. You don't even know if you'll be alive, but you've paid rent. So you're demanding the landlord. That is an asset to you. It's a receivable. Ideally, you'd have called it a receivable, but because it's not your trading item, you call it a prepayment. So now the trick with this is you have to be very, very careful about dates. If they tell you that they paid from this month to this month, or they paid for different quarters, be very, very keen about what those quarters are and allocate the money accordingly. So accruals are expenses which relate to an accounting period but have not been paid for. Now, like Faith told us with a matching period, matching concept, expenses and revenues are recorded in the period to which they relate. If we have our financial year 2024, okay, all expenses that we incurred in 2024, whether they were paid for or not, have to be clearly shown in 2024 in our report for 2024. All incomes that we received, all incomes that we earned, whether we actually received them or we did not, have to be clearly shown in our financial year. So when I talk about relate to an accounting period, these if an item has been incurred in a particular accounting period, it has to be reported in that particular accounting period. If you have used up water in 2024 and the water bill is going to come in 2025, you used the water in 2024, even if the bill has come in 2025, you have to record that you used the water in 2024. Why? Because you use this water to help you make profits of 2024, not profits of 2025. Or use the water to help you make losses of 2024, not losses of 2025. This is futuristic. If you've already consumed something, then it's only right that you record it in the period in which you consumed it. That is on the expenses side. If you've already finalized the transaction and you expect to earn, it is only right that you record in the period in which the earning happened, not in which the money was received. Transactions are recorded as and when they occur, not as and when cash exchanges hands. So you have to be very, very, very keen with the timelines for accruals and prepayments. You have to be very, very keen. It's about time. Okay. So moving on. They are telling us that accruals are shown in the statement of financial position as a liability, like I've told you, because we've not yet paid from the, we accrue the expense to be paid in the future, in as much as we have consumed it in the past. Accrued expenses are charged against the profit for a particular period, even though they have not yet been paid for. So for example, if we have our tailoring business and we are using electric machines, okay, the profit that you make in that particular year will be very, like I'm going to use 2024. If let's say 2024, and you've used maybe 1,000 units of electricity in that particular year, those 1,000 units that you've used are helping you make profit in 2024. So there is no reason why you're going to say that you are recording the electricity in 2025. No. They will be charged for a particular profit in which they have been incurred, regardless of whether they've been paid for or not. So for accrued expenses, they reduce the profit for the period in which they happened. So if it's 2024, the expenses will reduce the profit for 2024, not 2025, even if we will pay in 2025. But the fact that we already incurred the expenses in 2024, we have to offset them against the profit. I hope it is making sense for now. We have then prepaid expenses. We call them prepayments. Like I said, you may like usually when you're starting a business, you pay like 6 months rent. In those 6 months, it's you who is demanding the landlord. The landlord has to smile when he passes by you, has to greet. And then you find that after 6 months and you've not paid, you're the one who is running away from the landlord. So a prepayment is an asset to our business because it's more like a receivable. It's an economic benefit it's going to enjoy due to its past dealings. So these are expenses which have already been paid but relate to a future accounting period. So I believe this is a bit clear, and they are shown in the financial statement, a financial position as an asset. We're saying that prepayments are payments which have been made in one accounting period but should not be charged against a profit until a later period because they relate to that later period. You will see these much more clear when we look at a full financial statement and you understand how an income statement looks like and its cutoff dates and how we charge everything else that doesn't relate to it or has probably paid in a particular year. So like what this is trying to say, if we have paid maybe for insurance, we have paid for insurance for 2 years, but we are only reporting we're trying to report to find profit for 2024, we have to cut off insurance for only 2024 and use that to determine the profit. It's what we are going to charge against the profit, not the insurance of 2025, even if we have paid out the money much earlier. So like I said, transactions are reported as and when they incur, not as and when cash is exchanged. So you have to properly allocate these transactions in their right timelines. So the accounting principle requires that the gross profit for a period should be calculated by matching the sale and the cost of goods in that particular period. So we know by now, that gross profit is equal to sales minus cost of sales. Okay, cost of the goods or cost of sales is the same thing. This is sales. The cost of sales, or is it the cost? You can still call it just cost. You buy a perfume. You buy a perfume at 500,000, and you find that the person selling it to you bought it only at 100,000. This absolutely insane profit is our gross profit, and it is recorded in the period that in which it has been incurred or in which it has happened. And so we're saying that in the same way, the net profit for a period should be calculated by exchanging the expenses which relate to that period. So if we are getting our gross profit, let's say for the year 2024, we will get, this is our year 2024. We'll get our gross profit. How are we going to get our gross profit? We're going to get the sales that we have made in 2024. Okay. Let me clear. We'll get our sales that we have made in 2024 Okay. And then we'll get our cost of goods or cost of sales. So let's say we have made sales of 1 million. We bought these goods at maybe 500,000 cost of goods. Cost of the goods sold, that is to say, at 500,000. Cost of goods sold in 2024. We'll look at this in a more elaborate way later on. I'm not going to get deeper into it, but we'll get the cost of the goods that we've sold. So giving us a gross profit of 500,000. So any expense that we have incurred that may reduce this to help us get our net profit, okay, should be relating directly to the period of 2024. So even if you got your 200, you got expenses maybe worth 200 because 500 minus the net, I'm just going to calculate backwards. This is our net profit. It means that we incurred expenses of 200. So let's say you decided to pay rent of 100,000. That is 50,000 for 2024. And let me put here 50K for 2024. Okay. And 50K for 2025. Okay. So you decided to get, you paid rent, and then maybe you paid salaries of 50,000. Okay. And maybe you paid the electricity of 50,000, and you paid maybe water for 50,000. So now, ideally, you spent 250,000. That's actual money that you actually spent because you paid rent for 2 years. But what the principal is saying is that we have to record expenses that relate to the period in which these sales were made. So there is no reason why you should be recording rent for 2025 because even first of all, you've not yet consumed it. So what you will do, you'll get this 100,000, okay? You get the 100,000 rent and remove only the rent for this year, which is going to be 50,000 because 2024 is 50,000 and 2025 is 50,000. And so instead of recording the rent at 100,000 because you didn't spend rent, there's no way you consume rent of 100,000, you will show the rent that actually relates to the 2024, which is the 50. And so when you add your 50 plus 50 plus 50 plus 50, that is 200. 200 worth of expenses minus the gross profit, which is 500, should give you a net profit of 300. And so in that way, you have respected the accruals concept. And you've also taken notice of the matching concept. So that's why I'm saying it's very important that we go back and revise these concepts and understand them very, very well. So in preparing the income statement for a business for a period of say 6 months, it will be appropriate to charge 6 months expenses for rent and local taxes, insurance costs and telephone costs, among others. So this illustration is basically saying, let's say we have paid expenses may not be paid for during the period to which let's say we have paid shop rent of 2 million per annum. That means for 12 months, and pays the full rent on 1st January each year. If we calculate the profit for the business for the first 6 months for the year 2021, the correct charge of the rent in the income statement is 1,000. How does this 1,000 come about? We paid 2 million rent for 1 year, which is equivalent to 12 months. But now, after 6 months, we want to know how much rent we have consumed, or we are reporting as of 6 months into the year. How are we going to record that? We know that 6 months into the year, we're going to get our 6 months into the year divided by the total 12 months times the 2 million, which will give us 1 million. So that means that the income statement will show at least for the report for those first 6 months will show that we have rent for 1 million, and the rest, if this was already paid, then it's going to be a prepayment of 1 million. So moving on. This is just an illustration. I'll send these notes after the lecture so that you can see how that happens. So we paid rent of two million by cash. And when we decided to report for half-year financial statements, we only recognize 1 million in as much as we had paid 2 million. And so that means that the rest of the other, it is prepaid rent for at least for the next 6 months. But when we come again and write this financial statements at the end of the year, you find that we are now recognizing all the 2 million because we have consumed all of it. Okay, we now have all the 2 million and there will be no accrual as well as no prepayment. So the double entry for this, prepayments are included in receivables, like I told you, in current assets, the statement of financial position. They are assets as they represent money that has been paid out in advance for the expense being incurred. I think this is a bit straightforward. And accruals are included in payables in current liabilities as they represent liabilities which have been incurred but have no, for which no invoice has yet been received. So this is how just a summary of how the entries look. We have our accrual. When it's an accrual, of course, we know that it's our expense. So we'll debit an expense and we'll debit the expense and we'll credit liability. Why? Because our liability is increasing and our expense is also increasing. So the expense is incurred in that period, but is not recorded. And then we have prepayment. In the event of that prepayment, we know that that is going to be our asset. So we'll debit our asset and we'll credit whatever the reduction is in the asset. Yeah. So I'm going to just elaborate just a bit. I'm going to try to demonstrate this. Let's first look through this. And the effect of the accruals and prepayments on the profit. The same for accruals, its effect on income expenses, it increases expenses. Let's use an example of a water bill. If let's say we have our water bill, we have incurred, we have spent water and we have maybe areas of like 100,000 in the month. Let's just assume that we are reporting for the month of May. And let's say by the time May ended, we had areas of 100,000, but we had already spent that water, we had already used it to help us make our profits. What is that going to mean? Is that 100,000, of course, increases our expenses. In as much as we have not yet paid it, it is going to increase our expense. And of course, when the expense increases, our profit is going to reduce. But the fact that even this expense that is increasing, we haven't yet paid it, our liabilities will also increase. So something for prepayments. On the other hand, maybe we had paid water in advance. Let's just reverse the situation and assume that we had paid water in advance. When that happens, it means that in the next month, okay, for May, we paid water also for June. That means that in June, we won't really have to pay a lot of money. Why? Because that money was already paid in May. In as much as we didn't recognize it in May, it was already paid then. So it will reduce the water expense that we should have been paying, and by that our profits are going to increase and our assets will increase because it's a receivable. For the prepayment of income, at times people may pay you income, like may pay you money. As a business, people may pay you before they actually utilize that money. For example, landlords receive money before people actually consume that rent. When you give a landlord money, automatically it's an obligation to them to make sure that you stay in that house. So what does that mean to businesses that receive income? Even a normal business may have like rentals or may have people who have paid them in advance. Like when you pay insurance people in advance, you on your side, it's an asset, but on their side, it's now a liability. Okay. So prepayment on income is going to reduce the income because now it's a liability. And then because of that, is also going to reduce the profit because that money is not yet actually utilized. So you may receive income for June when you're still in May. It doesn't mean that you recognize that income in May, you will have to accrue it and recognize it in the right period. And so, of course, we know that it's an obligation when someone has given you their money before you actually providing the service. And so it's going to be a liability. So that is it basically about prepayments and accruals. We'll look at it best when we look at financial statements. But do we have an understanding of it? Does it make sense? Does that make sense? Do we have any questions? Okay, if we have no questions, next week, on Wednesday, we'll be looking at bad debts. And if time allows, I'll introduce financial statements. So please come ready to ask me your questions with bad debts and whatnot. And also try to make it for the lecture. Thank you so much for your time. Have a good night.